Corporate Finance for Economists. Lectures number 4. Working Capital Management. In these chapters, we're going to learn about the working capital policy, how to interpret cash conversion cycle, and then the applications will be on inventory management, account receivable management, and management of account payables. The lectures will end with a concept of cash management. Students will be learning how to prepare a cash budget. Let's look at the terminology. When we refer to working capital, we refer to operating short-term asset or current asset. The terms net in net working capital refers to current asset net of current liabilities or current assets minus current liabilities. When we add the terms operating, it becomes net operating working capitals or NWC. By adding the terms operating, we're going to look at short-term operating liabilities. We will subtract note payables, which is short-term borrowing, from the equations. So it will be current assets subtracted by current liabilities net of note payables. The term current assets investment policy refers to a situation that the management must decide on the levels of current assets that the firm will invest in. The main topic of this lecture is on working capital management. We will focus on cash management, accounts receivable management, inventory management, and accounts payable management. For example, if we look at the financial ratios, days sales outstanding. For this firm, it takes 45 days to collect money from the customers, where the industry average is around 32 days. For inventory turnover ratios, our firms turn the inventory over about 4.8 times a year, which is a lot slower than the industry average. Under the working capital management, we will see how we could manage or improve these operating short-term assets. A general analysis here suggests that the firm has too much working capital or current assets given a current level of sales. Preliminary analysis could go either that the firm is very conservative or the firm just being inefficient, too much inventory, collect the money from the customer too slow. In a preliminary analysis, we look at the profitability ratios of the firms. It suggests that the firm is not as profitable as the industry average. Our preliminary conclusions, this may suggest that the firm has excessive current assets. Before we move into specific type of assets to carry on the analysis, we can look at the working capital management policy in general. When we invest in short-term assets, we can use the short-term financing to support an investment in short-term assets. If we invest in plant, properties, and equipment, these fixed assets are long-term. So we could use long-term financing such as long-term debt or common stock to finance an investment in the fixed asset. This strategy is to match the maturity of the asset and the maturity of the liabilities. However, for some companies, they may use an aggressive working capital management policy, which means they're going to use short-term financing such as short-term borrowing from a bank to finance an investment in the long-term assets. On the other hand, if the company is too conservative, the company may use long-term debt or long-term capital to support an investment in both short-term asset and long-term asset. One particular topic that we can look under the net working capital management is to calculate the cash conversion cycles of the company. The cash conversion cycle is composed of three parts. First, focus on the inventory management. We can calculate how many days does it take the company to sell the product. The second component is on the customers or account receivables. How many days does it take the companies to collect the money from the customers? We add these two terms together, then we see the whole period that it takes for the company to convert one single product into cash. Under the cash conversion cycle, we will subtract the numbers of days that the company pay the suppliers. So the third component represents accounts payable. Now let's look at an example. On average, it takes the company 76 days to sell a product. Sales are on credit. The company must give credit term to the customers. Then it will take another 46 days to collect the money from the customers. You add these two terms together, it will take about 120 days before the companies can turn an average product into cash. The cash conversion cycle will subtract the numbers of days that the company receives trade credit from the suppliers. In this example, the supplier provides a credit terms of 30 days. So 122 days subtracted by 30 days, the cash conversion cycle is net of 92 days. So the company must have enough cash to operate during this 92 days period. There will be no cash coming in during this 92 days period. And examples in this lecture seem to show that the company is being inefficient in managing short-term operating asset. Do we invest too much in the inventory? Now, by looking at the analysis, the company inventory turnover ratio is less than an industry average. We now can confirm that the company is carrying a large amount of inventories given a current levels of sales. With these excessive inventories, there will be operating costs sunk into the company, which will reduce a profitability of the companies. By improving inventory management, the company would be able to increase its profitability and the value to the shareholders. What would be a solution for this inventory management? In short, the company should reduce a level of inventory. By doing this, it will improve a cash positions of the firm, especially in the short run. When inventory purchase decline, the company gonna get to keep some cash. The company will be able to reduce short-term financing to invest in the short-term asset. Over the long run, the excess cash saved from lowering an investment in inventory can be used to make additional investment in more productive assets, such as plant, properties, and equipment. And this will increase operating income of the firms, and as a result, it will increase the value of the firms. Or this excess cash can be used to pay dividends to the shareholders. It will increase the value of the stock price of the firm, and it will help to lower the cost of capital for the firms. Next question is on account receivable management. Currently, the company spends 45 days to collect the money from the customers, while the industry practice keep credit terms about 32 days. Collecting the money too slow. A simple solution to this should be tightening the company credit policy. Collect the money from the customer quicker. However, this restrictive credit policy may discourage sales, causing the customer to switch to the competitors. There might be additional benefit besides cash improvement because there will be less account receivable outstanding so the amount of bad debt will be lower as well. For the accounts payable management, we are talking about trade credit that the suppliers give to the firm. Trade credits should not be overlooked because this would be a free source of short-term credit from the suppliers. It's very important, especially for small firms. However, these demonstrated calculations will show that the cost of trade credit can be very high. Let's hypothesize that a company buys raw material from suppliers in an amount of $3.03 million. The credit terms that the suppliers give to the firms is 30-day credit. However, if the company pays within 10 days, the company will receive 1% discount on the purchase. In a calculations of financial ratio, we can calculate how many days does it take the company to pay the suppliers. For example, the company pay the suppliers 40 days, which is 10 days beyond the credit terms. And the suppliers say, we okay with that. The company will not be able to take a 1% discount on a purchase. This is the amount that the company gives out. Based on a net purchase of $3 million, there are 365 days a year. Every day, on average, the company spends $8,219 on the purchase from suppliers. Given a situation that the company takes 40 days to pay the suppliers, the amount of accounts payable outstanding would be equal to $328,767. In these situations, the company will not be able to take a 1% discount on the purchase. On the other hand, if the company wants to take a 1% discount, the company must pay suppliers within 10 days. If 10 days is the amount of account payable outstanding, so the account payable will be $82,192. Comparing between the two numbers, if we pay suppliers 40 days, instead of paying, the company will get to keep this cash for 30 days. $246,575 represent extra trade credit from suppliers. We can calculate a cost of trade credit by comparing between 1 and 2. Number 1, by paying suppliers 40 days, our companies give up $30,000 in saving. However, our companies get to keep $246,575 for another 30 days. So by using 1 divided by 2, we can calculate a cost of trade credit equal to 12.29%. What does this mean? If a company can borrow from a bank and pay an interest of 8%, the company should borrow the money from the bank short term and use that cash to pay the suppliers quicker. By not taking the trade credit or by not paying the suppliers within 10 days, the company gives up an opportunity for saving of $30,000, which represent 12.29%. So the cost of trade credit of 12.29% will be greater than the cost of borrowing from a bank of 8%. The company should borrow short-term from a bank and pay the suppliers within 10 days to receive trade discount. The cost of trade credit can be calculated by using a formula. So because we're gonna get 1% discount, this is 1 divided by 99. The numbers of days that the companies pay the suppliers 40 days. The numbers of days that the company gonna receive trade credit is 10 days. So plug into the formula, the cost of trade credits is around 12.29%. So we can calculate using either approach. We now look at an example of our listed company, Advanced Info Service. On the last page of the information of this listed company, we have information on financial ratios and cash conversion cycle. In this example, and see that it takes about 40 days for the company to collect money from the customers. It takes about 14 days for the company to turn the inventory or sell the inventory out to the customers. On the other hand, it takes over 120 days for the company to pay suppliers. So the cash conversion cycle will be calculated as 39.76 days plus 14 days subtracted by 128.94 days. We see a situation that this company have a negative cash conversion cycle, which is the opposite of normal situations that the cash conversion cycle is usually positive. The company pay the suppliers very slow. The company get to use the money from the suppliers, and this is free. So whenever you see a negative cash conversion cycle, it may suggest that the company has the bargaining powers over the suppliers. The last topic of the lectures will be on cash management, and we will practice an analysis or a preparations of a cash budget on our case studies. In a cash management process, we will learn how to prepare a cash budget. In a cash budget, we will forecast cash inflow and cash outflow. If at particular points of time, the cash is not enough, we can calculate an amount of loans that will be needed. Cash budget can be daily, weekly, or monthly. For an annual planning process, we might as well prepare a monthly cash budget. But for active cash management, we may use a daily cash budget. This is an example of a monthly cash budget. We extract only 2 months for a demonstration purpose, January and February. The first block represents cash collection from the customers. The second block represents cash payment. When we use collection, which represents cash inflow, subtracted by cash payment, which represents cash outflow, we can calculate net cash flows every month. In the second part of the monthly cash budget, we will incorporate the amount of cash that we have at the beginning of each month plus net cash flow. This is how much cash that the firm has in January, $16,857. For some particular business, we might have some cash on reserves. So this is the target cash amount that the company must keep. Whatever left, core or surplus here, can be used for any activity, operating, investing, or paying back the creditors. This monthly cash budget shows that the company has sufficient cash in January and in February. Let's do an analysis of the company cash management policy. An analyst suggests that the company is holding too much cash. One way is to look at it. The company probably follows a conservative cash management policy because if sales turn out to be less than expected, the company would not have a problem with cash position because the company have more than sufficient cash on hand. On the other hand, look from the perspective of the shareholders. The company can pay this extra cash to the shareholders in the forms of dividend. This will increase the value of the stock price and increase the wealth of the shareholders. In addition, this extra cash can be used to fund future investments of the company. These are all possible scenarios of the company's existing cash management policy. For everyone to grasp an idea of how cash management can be applied to corporate finance, we will look at a case study. Case analysis, Hampton Machine Tool. The case takes you into September 14, 1979. The company is having the following situation. The company has requested a renewal of an existing $1 million loan, which gonna be due at the end of the month or in next 2 weeks. And at the same time, the company is asking for additional loans of $350,000. This will be for a purchase of new equipment in October. We are now at the middle of September. The companies will not be able to pay back the existing $1 million loans, which is gonna due in 2 weeks. And at the same time, next month, the company would need additional borrowing from a bank. A total of $1.35 million will be paid back to a bank at the end of the year. We are now on a very tight schedule to manage 3.5 months of cash for the company. Let's look at other information. Hampton Machine Tool major customers are aircraft manufacturers and automobile manufacturers. The company does not sell products to the end customer, they sell to intermediate producer. During the rough years prior to 1979, Hampton produced its machines at below capacity. As such, the company has substantial backlogs of sales orders. The company must increase its production to meet these substantial backlogs. The orders have arrived, but the company have not shipped the product to their customers yet. In the last paragraph of the first page, it specifies that the company has a conservative financial policy, which means that the company had no debt on its balance sheet prior to December 1978 or last year. What happens then? Why the company has a situation that it has $1 million in debt and is not able to pay back to the bank this month? The case specifies that the president of the company borrowed $1 million to purchase the stock from other shareholders. So this represents a financing decisions of the company, not an operating decisions of the company. By looking at the operations of the firm, the company was able to use a conservative financial policy. But because of this extra activity, which represent a purchasing of stock from others unhappy shareholders, interest rate on an existing loan is 1.5% per month or 18% a year. Let's look at additional information on the third and the fourth paragraphs. In the third paragraph, the case specifies that the company credit terms to the customers are 30 days. So the company provides 30-day credit to its customer. From the supplier side, the company purchases material from suppliers, and the suppliers give the company 30 days credit as well. In the last paragraph, the case reflects the situations that the company will need additional loans of $350,000 to finance the equipment purchase. The interest on the new loans will be 1.5% per month, which is the same as the existing loan. So you can use this number in your projections of cash. Let's look at each exhibit. We are now in the middle of September. So the revised number has been given to the management on the third column. This is a set of revised sales forecast. So you should use this number in the preparations of your cash budget. In Exhibit 2, we have a balance sheet at the end of August. So at the end of August, the company has cash equal to $1.5 million. The unit of this balance sheet is in $1,000. So the cash at the end of August is $1.5 million. The companies borrow $1 million from a bank since December of last year. With cash at the end of August with cash of $1.5 million and note payable equal to $1 million. You're probably wondering why the company just used this cash to pay back to the bank. However, it cannot, because based on this $1.5 million in cash is the advance payment received from the customer. The industry practice is customers must provide some deposit before Hampton will produce machines. So customer has provided this advance payment to the company to use as working capital. The company already has obligation. This cash of $1.5 million already has operating obligation, cannot be used to pay back to the banks. Putting these Exhibit 1 and Exhibit 2 together, the company has revised the shipment during the last 4 months of the year. In the previous 8 months, the company has not been able to ship the products to the customer as expected. That's why there are some backlog. And the company hopes to catch up or delivers the product during the last 4 months of the year, and cash would be coming in as a result. That's why the company asked the bank to extend the due date until the end of the year. Nothing to focus much on Exhibit 3, I'm going to skip it. In Exhibit 4, the first paragraph restates the cash and analyze Exhibit 2 that the cash balance of $1.559 million is an obligation to the customer. The customer provides cash advance. The customer provides deposit before making an order. Let's make some correction that the interest per month will be 1.5% a month, which is equal to the interest rate charged on the existing loan from the bank. Other information in Exhibit 4. The company expects to purchase raw material from a supplier in an amount of $600,000 a month. And the numbers of revised shipments in the box also corresponding with the number in Exhibit 1. In the box, you should carefully incorporate this information in preparing a cash budget for Hampton. This is one big customer, General Aircraft Corporation. This customer placed an order equal to $2.1 million. The shipment has been separated into 3 parts: September, October, and November. This is a customer that provides a cash payment in advance of $1.566 million that we see in the company balance sheet. When the companies make shipments to the General Aircraft, the shipments will be subtracted out from advance payment that the company made. Until this advance payment is exhausted or being used, then the company will collect additional cash from General Aircraft. The second paragraph of the case states that other operating expenses besides purchase of raw materials will be about $400,000 a month. The companies will pay taxes of $181,000 on September 14th and December 15th. The last set of information, the companies will make a dividend payment of $150,000 in December. Your assignment is to find out whether at the end of the year, Hampton will be able to pay back $1.35 million to a bank. This is a case template that you can use to find out whether Hampton would be able to pay back the bank $1.35 million at the end of 1979. You are on a cash management schedule of 4 to 5 months at the end of the year to convince the bank that Hampton deserves first an extension of an existing $1 million loan. Second, an additional loan of $350,000. And third, all in all, the company should be able to pay back to the bank $1.35 million at the end of 1979. Good luck on this case analysis.